5 seconds of silence.
Welcome. Today we will conduct a detailed examination of the principles and applications of a job order cost accounting system.
Our analysis will proceed through 5 distinct, logical sections. We'll begin by establishing the foundational concepts, then trace how manufacturing costs are accumulated. After that, we'll examine the process of assigning those costs to a job, follow the costs as the job is completed and sold, and finally, address the essential task of reconciling overhead costs at the end of the period.
So, let us begin. In this first section, we will establish the core principles that underpin the entire system and distinguish between the primary classifications of cost systems you'll encounter.
At its core, what is cost accounting? Well, you can think of it as a systematic process. It involves the meticulous measuring, recording, and reporting of all product costs. The ultimate goal, as you can see, is to ascertain not only the total cost of production, but also the unit cost for each item produced. This data is absolutely critical for effective management.
It's critical to understand that there are 2 primary systems for cost accounting. First, you have the processed cost system. This is used when a company produces a large volume of similar homogeneous products. Think of a beverage bottling plant, for instance. But our focus today is on the job order cost system. This system is fundamentally different. Costs are meticulously assigned to each discrete job or batch, making it perfectly suited for businesses creating unique products.
Now we move to our second section, where we will trace the accumulation of manufacturing costs. In any production environment, there are 3 primary categories of costs: raw materials, factory labor, and manufacturing overhead. We're going to examine the initial recording of each of these 3 inputs.
The entire process, logically, begins with the acquisition of materials. As you see in this journal entry, the company has purchased $42,000 of raw materials. Notice the accounting treatment: we debit the raw materials inventory account, increasing that asset, and concurrently, we credit accounts payable, which reflects the liability to the supplier.
Simultaneously, we must account for factory labor costs. For this period, the total incurred is $32,000. It's important to remember this isn't just wages. It also encompasses employer payroll taxes and benefits. These costs are initially recorded in a temporary clearing account called factory labor.
And that brings us to the third category, manufacturing overhead. This account is something of a catch-all for all indirect product costs. We're talking about things like factory utilities, property taxes on the plant, and depreciation of equipment. All of these indirect costs, amounting to $13,800 here, are accumulated in the manufacturing overhead control account. All right, so having accumulated these 3 distinct cost pools, we now arrive at a crucial step, assigning these costs to specific jobs currently in production. This is where the costs begin their journey into the work-in-process inventory account.
The central document that facilitates this process is the job cost sheet. You should view this as a subsidiary ledger for the work-in-process account. Its purpose is to record and summarize all manufacturing costs, materials, labor, and overhead that are chargeable to one specific job.
So, how are materials assigned? Notice the distinction in this entry. We see that $30,000 in materials were issued. Of that, $24,000 could be directly traced to specific jobs. That's our direct materials, and it's debited to work-in-process inventory. The remaining $6,000 represents indirect materials, so they are debited to the manufacturing overhead account.
The assignment of labor follows very similar logic. Of the $32,000 in total factory labor, we can trace $28,000 directly to employees working on specific jobs. This is direct labor, and it's assigned to work in process. The other $4,000 represents indirect labor. Think of maintenance staff or supervisors. This cost is assigned to manufacturing overhead.
And this leads us to a fundamental challenge. It's relatively straightforward to trace direct materials and direct labor, but how do we achieve an equitable allocation of manufacturing overhead costs, like factory rent, to specific jobs? These costs, by their very nature, cannot be directly traced.
The solution employed in practice is the use of a predetermined overhead rate. This rate is calculated before the accounting period begins. The formula is quite simple. You take your estimated total annual overhead costs and divide them by an expected annual operating activity, like direct labor hours or machine hours.
Using this rate, we can now apply overhead costs to our jobs. In this entry, a total of $22,400 of overhead is applied. We debit work-in-process inventory to add this cost to the jobs, and we credit the manufacturing overhead account. Now all 3 product costs have been assigned.
Now that we understand how costs are assigned, let us follow the cost flow as a job is brought to completion and subsequently sold. This will take us from production all the way to revenue recognition.
Upon the completion of a specific job, its job cost sheet is finalized. The total cost, which we see is $39,000, is then transferred out of the work in process inventory account and into the finished goods inventory account. This signifies that the product is complete and ready for sale.
The sale of the job necessitates a two-part journal entry. First, we must recognize the revenue. We debit accounts receivable for $50,000 and credit sales. Second, we must recognize the expense. The cost of the item sold, $39,000, is transferred from finished goods inventory to the cost of goods sold account.
We now arrive at our final section, the reconciliation of overhead costs. The overhead applied to jobs was based on a predetermined estimate. It's almost certain that this applied amount will differ from the actual overhead costs incurred, and this variance must be addressed.
At the end of the accounting period, any remaining balance in the manufacturing overhead account must be analyzed. A debit balance means that actual overhead exceeded the overhead applied. This is known as under-applied overhead. Conversely, a credit balance signifies that we applied more overhead than was actually incurred. This is called over-applied overhead.
Accounting principles provide two primary methods for eliminating this balance. If the variance is non-material, meaning it's too small to influence a user's decision, it's typically closed directly to cost of goods sold. However, if the balance is material, the proper procedure is to allocate it proportionally among the accounts where the overhead resides: work in process, finished goods, and cost of goods sold.
In summary, an objective evaluation of the job order cost system reveals distinct advantages and disadvantages. It provides precise cost data for profitability analysis and pricing decisions. On the other hand, it requires significant record keeping, and its accuracy is ultimately contingent upon the precision of the overhead allocation.
This brings us to a critical, forward-looking question. As manufacturing becomes increasingly automated, direct labor diminishes. Consequently, traditional overhead allocation bases like direct labor hours become less relevant. So the question is, how must these allocation bases evolve to maintain costing accuracy? This remains a significant challenge for the modern cost accountant.